This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Steve Saretsky here. Welcome back to the show. Lots to chat on this week. We obviously had the Bank of Canada coming out, raising rates, another 25 basis points, shocking the bond market, bond yields surging higher. That's going to filter through into people's mortgages. You've also got an update on the immigration numbers, federal government deficit spending, and how that's all impacting the Bank of Canada's current decision, and how I think it's going to impact not just the real estate market, but people's Canadian households' finances moving forward, because I think there's a lot to unpack here, and I think this is going to be a very, very important video. So let's frame it up this week with really, again, the Bank of Canada coming out, raising rates 25 basis points. Now, again, I know there's a lot of people here on YouTube, Twitter, etc., that pretend to know every single move the Bank of Canada is going to do. The bond market was pricing about a 30% probability of a rate hike here in June. There was a higher probability, I believe about a 70% odds for a rate hike in July. So the fact that the Bank of Canada moved in June ahead of the market definitely was a shock. The reason why you can see it was a shock is because you can see the abrupt movement in bond yields that day. Bond yields moved up by about 20 basis points across most of the curve, which again suggests to me that the bond market was not positioned for that move from the Bank of Canada. And it wasn't just happening in Canada, it was actually happening across a lot of these developed markets. So the Bank of Canada certainly did shock markets. Again, coming off a conditional pause and then raising rates. Again, typically the framework for central banks over decades and decades of history is when they go on a rate hiking crusade, you raise rates, eventually you'll pause, and then you'll typically, almost always, the next move after that, whether that be 3 months, 6 months, 12 months, is a rate cut, as you go into recession, etc. So the fact that they sort of hiked, paused, and then hiked again is certainly alarming. I know that from a sentiment perspective, I think personally it is going to impact the housing market from a sentiment perspective. I think we certainly did get a lift in activity, over the last seven months here. Is basically bond yields had essentially peaked out. They peaked out last, September, October. Mortgage rates sort of eased off from about 5.5 down to about 4.7, kind of trading in that range for the last 4 or 5 months. Bank of Canada moves to the sidelines. It seems, people start reemerging out of the woodwork. Housing prices start stabilizing. Inventory drops to 20-year lows. Prices start reaccelerating to the upside. People say, okay, well, maybe I missed it. Jumping back into the housing market. Again, prices continue to push higher. So now all of a sudden they're like, oh, wait a minute. Maybe interest rate hikes aren't over. And the game, there's still risk here moving forward, which again, I have certainly argued. I know there was we talked about on this show, there was a prominent company that came out and predicted, that housing would sort of be fairly resilient, and the Bank of Canada would start cutting rates, this July. And I said, well, if the housing market is going to be resilient, it gives an excuse for the Bank of Canada to maintain their tight policy stance, right? Because they're like, well, clearly the market's ability to absorb this. And so I think that's really what we've been seeing, right? Is we're seeing the data obviously come in a little bit stronger. We're seeing housing, despite 400 plus basis points of rate hikes, it hasn't really cracked yet. It did go through the sharpest decline ever over a 9-month period, but then it was kind of back off to the races. Now, I really want to clip in, post this rate hike here. Again, we've seen mortgage rates going back up. Your 3-year fixed rate mortgage, which is what most of the market's going with today, has moved up from about 4.8 to about 5.20. So, we moved up about 40 basis points over the past 3-4 weeks. So that's going to take some steam out of the market. But I really want to clip to the Bank of Canada's comments. The following day after the rate hike, they had, I believe it was Deputy Governor Paul Beaudry came out and he gave a speech on sort of the Bank of Canada's rationale. So I want to clip to his comments right now.
So if we go back to our April decision, already in April we were already seeing a set of forces that were kind of getting us worried about that aspect of whether we had enough monetary tightening. And we kind of thought at that point whether we might have to increase rates. And that kind of came out. We have this summary of deliberations which kind of discusses the issues we've brought up. In particular, we were seeing certain things. Since we started the pause, just repeatedly we've been surprised about the strength of the labor market. How much, that's been a very robust type of labor market. Unemployment has stayed at these historical lows. We've also been kind of the aspect of looking how core inflation. So we have the standard inflation that you see, kind of the average of all the prices. But there's an aspect that we call core inflation, which is more taking out the more volatile aspects like energy and food and looking at underlying trends. And we kind of want to think. That helps us think more about what could happen to inflation going forward. So we often look at these core measures, and they've been kind of more sticky and not kind of coming down very, very quickly. And those were the type of things that we were looking at. We saw all sorts of elements. So we already kind of picking up. What's happened since then, since that April decision? Well, data's come in a way to tip that balance. We've kind of seen different things, so we've had an accumulation of evidence on many fronts over time and across a whole set that tell us now that inflation seems to be more sticky and it's going to be harder to get it down to that 2%. And it's that accumulation of evidence that kind of brought us to our decision yesterday. So I'm going to go through some of those pieces of evidence that was from the April part to now. So thinking first about economic activity. So we were first surprised on the upside from the kind of growth in the first quarter. So the national accounts came out, and we were kind of predicting more of a 2.3. It kind of came up at 3.1. So that doesn't look too bad. But when we look in kind of the details, what we notice is what's the big driver there is consumption. Consumption came in at 5.8% growth. That's very high growth. And it was very broad-based across a whole bunch of aspects here. So if we're looking like services, not surprising, with the pandemic and things, services went down and we've kind of seen them kind of coming up. But we thought by now they'd be kind of slowly kind of easing off in terms of that kind of growth rate. And no, we didn't see that. The services just continued. Even more surprising, goods had been taking off. Like a lot of people bought a lot of goods during the pandemic and things, and we kind of thought, that would be showing. And it was kind of going down for a while. Now it's ticked back up. And it's that aspect that really kind of suggests this kind of strength in the economy. Now, we've spent quite a bit of time kind of asking, okay, what's happening here? Could this just be reflecting the kind of changes in the immigration coming in, which is quite strong? Could it just be that pent-up demand that's in the background? Could it be different aspects that's still in the supply chains? We went through all that. But by the end, all those things were playing a role, but by the end, we really felt the momentum in the economy is still very strong, and that's the aspect that we are kind of noticing there. And we again see it in the labor market. Okay, unemployment is still at this historical low. We are seeing vacancies come down a bit, so we are seeing monetary policy kind of having some bite, but it's actually been slower than we've been thinking. We've also spent quite a bit of time looking at directly the inflation numbers. Okay, so the last inflation number came in at 4.4, and that was actually an increase. We hadn't had an increase in the inflation rate for almost like 10 months, and that was actually an increase from the previous month. Not by much, just went up from 4.3 to 4.4, but it's kind of going in the wrong direction. We were expecting it to kind of come back down. And again there, when we looked at kind of more in detail what was happening when we were looking at these core measures of inflation, the inflation parts that we think is kind of really gets ingrained and kind of entrenched in the system, that was no more showing any kind of this decreasing part. So now, when we look forward here over the next few months, we still expect this headline aspect, so the standard number of inflation, should be coming down, and by the aspect of kind of coming down maybe to 3%, probably close to 3% by the summer. But that's almost all driven by the price of oil. These aspects underlying are not coming down. So why the oil price matters, these are yearly measures, so it's kind of like saying last year oil was a lot more expensive than it is now, and that's really what's kind of giving that decline in that part. But to really figure out what's happening, we kind of look at those core measures, and we've been more worried about that. So In summary, when we look at this aspect through this lens of both looking at the dynamics of inflation combined with excess demand, this very high activity levels, that really has increased the risk that we're not going to be able to kind of get our inflation down without a bit more monetary tightening. And it's that accumulation of evidence that led us to kind of our decision yesterday.
So what's interesting here is that the Bank of Canada is concerned. The fact that they are surprised. This is a very, very hawkish speech. And so based on this speech, unless the data completely deteriorates over the next 3-4 weeks, I would fully expect, based on this speech alone, that the Bank of Canada will hike rates again in July. Now, again, I'm not saying that I believe that they should. I don't think that central bankers are necessarily the be-all, end-all forward thinking. I mean, again, we have to remember that central banks have completely missed this whole inflationary saga, right? They were telling us it was transitory for basically 2 years. They started raising rates a month after the housing market officially peaked. So to say that they're going to be forward-looking, I actually don't. My personal bias is that they're actually going to over-tighten, that we haven't actually let these rate hikes filter through into the market. Remember, again, only 1/3 of Canadians have actually seen a mortgage payment increase due to the lag effects of interest rates, monetary policy, and banks extending amortization. So I think that they're going to ultimately over-tighten here. But what is interesting is to mention, he talks about strong consumption, but when you really start to actually strip out consumption based on population growth, we had 150,000 permanent residents in Q1 of this year, the most on record by a country mile. We just had, for April data, over 183,000 non-permanent residents in a single month. Again, the most on record. So if you're just going to import the whole country, the whole world into this country, naturally your number is going to go up. So if you actually, on a real GDP, real per capita basis, retail spending has been flat for many years now. So on the consumption side, I still think these higher rates are going to bite. But there is a case to be made from the Bank of Canada here, which he later went on in that speech. I didn't clip it in, but basically he says, listen, there is a real risk that inflation is going to be stickier and that we could be in a higher for longer environment. And I would argue that I think there's a very, very strong case for that. I think that 3% inflation is probably the new 2%, and central banks might not actually have the ability to get it back down to 2%. And this would kind of coincide with Russell Napier's financial repression, which is central banks, you can only do so much if you have the fiscal side, i.e. the federal government continuing to spend and counteracting what the central banks are doing. You kind of have this tug of war. And so I don't think that the economy is going to be able to withstand these higher rates for that long. So what I mean by that is, again, the federal government right now in this country, in Canada, is doing the exact opposite of what the Bank of Canada is trying to do. So by importing more immigration to this country, artificially inflating GDP, number one. But number two is they've just passed Bill C-47, which is an additional $20 billion, 20 billion, B with a billion with a B, $20 billion in additional deficit spending. It included obviously dental care, a grocery bill rebate, and all sorts of stuff. And so you're adding on additional fiscal deficit spending at a time when the Bank of Canada is essentially asking all of Canadians to pull back on consumption. Stop spending money. We need higher unemployment. We need a few people to lose jobs. We need people to spend less money. We need employers and companies to pay people a little bit less. We need consumption and spending to come down so we can get inflation down. But yet you're, again, by importing more people into the country and then I'm opening up the taps to spend more money and cut households' checks for their groceries is inflationary. And so this is why I think it is ultimately going to be a struggle for the Bank of Canada to get back down to that 2% target. And so I ultimately think that we're going to be in a scenario where something is going to have to break first, and they're going to realize, okay, and I do think housing ultimately is going to have to take a hit, and whether that's in prices or in sales, housing activity is going to have to slow rather significantly, and we're going to have to enter into that recession. It's just the reality that it is. Now, we've already seen building permits, which are a leading economic indicator. If you go to any macro research firm, they will cite building permits as a leading indicator for future economic activity. Because building, whether it's residential or commercial, etc., building and construction is a very large component of most advanced economies. And so we've seen an 18% decline in building permits year over year in the month of April, the lowest reading since December of 2020. So it's happening, and anecdotally you have conversations with developers, people in the industry. What's happening? Well, listen, the reality is the cost of financing, the cost of building these projects. So you got to carry, like if you're building an apartment building, you're probably carrying construction financing interest costs for the next 2 to 3 years. Well, that's a very large expense item in your pro forma. And so it's actually making a lot of these projects unfeasible. So you're seeing a lot of these new developments are actually coming offline, and you're seeing a lot of them now going out for sale, canceling, etc. So that to me is that sort of your forward-looking indicator that things are ultimately going to slow further. But this is kind of this tug of war. And like I said, I don't think central banks are forward looking. I think ultimately housing is going to have to slow. Now, the problem on housing right now is, and the Bank of Canada talks about, housing's been more resilient. Well, yeah, it's true. It has definitely been more resilient. I've been surprised personally, but I've been most surprised because it's been a 20-year low in new listings for like 6 or 7 consecutive months in a row. And so as of right now, you've got standing inventory in Greater Vancouver market, at 20-year lows. In the GTA, you've got 1.3 months of supply available for sale. And so in that environment, it's just really, really difficult to get lower prices. You need the inventory to grow and to build in order to get lower price. And again, of course, it doesn't help if banks are extending everybody's amortizations on their variable rate mortgages, so you're not required to sort of enter into a forced sale and add inventory to the market. So that certainly hasn't been helping. So you have a lot of forces kind of going against the Bank of Canada, and it seems like the Bank of Canada is trying to do this job essentially on their own. And again, I'm not convinced that they're going to be capable of doing that. But housing from a sentiment perspective, I think it takes a hit here. Mortgage rates, like we said, going up, still below sort of the peaks of last fall. We'll seemingly, based on Paul Beaudry's speech here, we'll seemingly get another rate hike in the month of July. So there's going to be a lot of households here that I think are going to be looking around and figuring out, okay, how do I get through this? How do I manage an extra $1,000 a month on my mortgage payment? Where am I going to start cutting spending? And again, yes, I've been surprised, consumption still looks okay, but if you continue to import, million plus people into this country every year, it tends to distort those numbers. So I think on whole, I think most Canadians today would probably tell you things are a little bit tougher. Things aren't as great as they were a year ago. I think the average household would probably tell you that. And it's unfortunate because it doesn't necessarily show up in the data, which the Bank of Canada is relying on data, which I think ultimately is a lagging indicator. It's why they missed inflation on the way up. And I think it's probably why they'll miss, ultimately they'll end up over tightening on this cycle. So that's kind of my thoughts on it. Hope this helps. I think it's going to be, like I said, I think it's going to be troubling times, concerning times. Again, seeing what the policy measures that some of our elected officials are taking right now is extremely concerning, because ultimately, again, as the government continues to spend and add in unlimited immigration, you ultimately are going to be in a scenario where it is going to prompt the Bank of Canada to leave rates higher for longer than they otherwise would need to be. And so ultimately I look at it and say, you're ultimately going to end up hurting the constituents you're hoping to help, the people that you're hoping to help, because you think about who is most impacted by rising interest rates, the cost on servicing a mortgage. Well, it tends to be sort of more of your blue collar working class. People always ask me where are the vulnerabilities in the housing market. And we'll go, well, it's not in the detached market on the west side of Vancouver, where over 50% of households don't have a mortgage,
these homes go for $3, $4, $5 million, and a lot of these buyers are, asset rich buyers that a lot of them aren't even taking on mortgages when they go and buy. They're coming with all cash or very low mortgages. And yet you go to, some of these suburban markets, Langley, Abbotsford, etc., blue collar, working class, young families that are taking out, $800,000, $1 million, $1.1 million mortgages. And they are dependent on their income. They don't have that additional disposable income. So that's where more of like your sort of like leverage is. There's not a lot of wiggle room in some of those markets where I think you have sort of like your working class individuals. So and I think those are the people that are ultimately going to feel the brunt of rising interest rates and debt servicing, credit cards or home equity lines of credit, etc. So again, I hope that helps. I'm very curious to hear everybody's comments below. I think there's one thing to point out here is ultimately, whether they tell you or not, central banks are there to provide the illusion or to basically aid the government and to sort of keep the system afloat. And so, if you look at rising debt interest payments, I don't have the chart for Canada. There's a great chart here on the US where you can see debt servicing payments as an expense to the government continue to rise, and you're like, well, how sustainable is that? That doesn't seem very sustainable. We just went through this whole saga about this debt ceiling limit, etc. And so ultimately, the central banks at some point are going to have to. It can't go on forever, but there certainly can be a lot more pain between now until we get to that point where central banks are easing and coming in with what I think will be some bout of QE, whether that's 6 months from now or 24 months from now, given the levels of debt, 365% debt to GDP in the world today. So anyways, we'll see you next week.